is that China is the biggest EV market by far. It's been driving the growth for the last several years. Europe and the US are now catching up fast, and as we just get to new levels of penetration in the US.
Analysis, evaluation, and recommendation. NIO is a prominent player in the electric vehicle market and is known for its innovative designs and technological advancements. The company faces challenges despite its strengths, including profitability concerns and increasing debt. However, with the growing demand for electric vehicles and NIO's continuous efforts to improve, many investors wonder, can investing in NIO stock double your money?
First of all, I think NIO is in a very hyper-competitive market here in China. Obviously, there is a bit, and there's typically a pullback in the beginning of the year when you enter a new calendar year, as the year-end numbers tend to be inflated a bit as dealers close. But even with that, given how competitive the market is, they've had to take down pricing in the second half of last year in order to achieve the growth that they were able to do in the third and fourth quarter as they launch new products.
NIO stock is definitely more affordable compared to its competitors, trading at just 1.01 times sales and 0.99 times forward sales. However, this seemingly low valuation reflects the lack of confidence investors have in the company's future profitability. Unlike Tesla, which trades at much higher multiples but is profitable, NIO continues to struggle with losses and mounting debt, with net debt reaching $4.5 billion over the past 5 years. Despite hopes of turning a profit, the break-even point for NIO has been pushed back, possibly to 2027. Moreover, NIO's performance has been underwhelming compared to its Chinese EV peers. While the company saw a 14% increase in vehicle deliveries in March, the growth rate lags behind competitors like Li Auto, which experienced a 52.9% year-on-year rise in the first quarter of 2024. This slower growth raises concerns about NIO's ability to compete effectively in the market. Furthermore, NIO's unique selling proposition, its battery swapping technology, once thought to be a game changer, is now losing its value. With advancements in charging technology significantly reducing EV charging times, the need for battery swapping facilities may no longer be as crucial as before. This shift in the EV landscape challenges NIO's previous advantage and raises doubts about the sustainability of its business model. But despite NIO's challenges, did you know that analysts at Morgan Stanley are bullish on the company's future? According to a recent note from analyst Tim Seow, NIO's stock could potentially double from its recent levels. Seow reiterated an overweight rating on NIO shares, with an expected stock price of $10 per share. This projection represents a substantial 124% upside over the next 12 months. Seow and his team highlighted the relative strength in NIO's sales performance, particularly in March. Sales of the company's SUV models grew by over 40% month-over-month, while sales of smart electric sedans increased by more than 50%. This robust sales performance is a positive indicator of NIO's growth potential. Additionally, introducing new 2024 models, boasting improved computing power and product competitiveness, is expected to further drive sales momentum. NIO has also enhanced its battery as a service program, which offers quick battery replacements at swap stations throughout China. This program is seen as a key differentiator for NIO in the highly competitive Chinese EV market. Another important aspect to consider when evaluating NIO's potential as an investment is the sentiment of financial experts and analysts. In the last 3 months, 10 analysts have published ratings on NIO, providing insights into their perceptions of the company's performance. The average 12-month price target for NIO stands at $6.18, with a high estimate of $10 and a low estimate of $4. It's noteworthy that the current average price target has decreased by 23.7% from the previous average of $8.10. The recent evaluations and adjustments made by analysts shed light on how NIO is viewed within the financial community. Analysts such as Jiong Shao from Barclays and Paul Gong from UBS have lowered their ratings, indicating a more bearish outlook on NIO's prospects. On the other hand, analysts like Tim Seow from Morgan Stanley have maintained their bullish stance, reiterating an overweight rating and setting a price target of $10 per share. These varying assessments reflect the uncertainty surrounding NIO's future performance and the challenges the company faces in the competitive EV market. Now, according to data from Business Insider, NIO's market capitalization analysis reveals some notable insights. The company's market capitalization is positioned below industry benchmarks, suggesting constraints in size. This could be influenced by various factors such as growth expectations or operational capacity. When it comes to revenue challenges, NIO has faced difficulties in revenue growth over the past 3 months. As of December 31st, 2023, the company experienced a revenue decline of approximately -10.3%, indicating a decrease in top-line earnings. Compared to its peers in the consumer discretionary sector, NIO's revenue growth lags behind the industry average. However, despite these challenges, NIO demonstrates strong profitability and effective cost management with an impressive net margin of -32.7%. This surpasses industry averages and highlights the company's ability to maintain profitability despite revenue struggles. On the other hand, NIO's return on equity is below industry averages, indicating potential challenges in efficiently utilizing equity capital. With an ROE of -27.11%, the company may face hurdles in achieving optimal financial returns. Despite the lower ROE, NIO's return on assets exceeds industry benchmarks, reaching -5.09%. This signifies efficient asset management and suggests strong financial health for the company. However, it's important to note that NIO's debt management raises some concerns. The company's debt-to-equity ratio is notably higher than the industry average, standing at 1.36. This indicates that NIO relies more heavily on borrowed funds, which poses a higher level of financial risk. But before we move on, we just want to express our appreciation for watching this far. Meanwhile, a different stock analytics firm published an insightful analysis regarding NIO's recent delivery projection update. According to this report, NIO expects approximately 30,000 electric vehicle deliveries for the first quarter, down from a prior forecast of 31,000 to 33,000 vehicles. This adjustment implies around 11,813 vehicles to be delivered in March alone. While this guidance may have initially sparked negative reactions among investors, it's essential to put it into perspective. Compared to the lower end of the previous guidance, NIO's adjusted outlook only represents a moderate 3% decrease. Therefore, this new guidance should not be perceived as a significant setback for the company. Looking ahead, NIO remains on track to deliver 120,000 electric vehicles in 2023. However, it's crucial to consider the seasonal factors influencing first-quarter deliveries. The inclusion of the 15-day Chinese New Year period tends to skew delivery numbers, leading to a rebound in subsequent quarters. For instance, between the first and fourth quarters of 2023, NIO's deliveries surged by a remarkable 61%. During the Chinese New Year holidays, factory activity halts as workers return to their provinces, impacting delivery volumes for electric vehicle companies. Nevertheless, as workers resume their duties and factories return to normal operations, NIO and other electric vehicle manufacturers are expected to witness production growth once again. In addition to the recent market fluctuations affecting NIO's stock, there are notable improvements in the company's gross profit situation. Despite a stock price decline following an outlook adjustment, NIO's gross profit in the fourth quarter of 2023 more than doubled compared to the previous year, reaching 1,279.2 million renminbi, or $180.2 million. Although NIO continues to face challenges in reaching profitability, the growth in deliveries expected in the first quarter of 2024 indicates a positive trajectory for the company's business expansion in the upcoming year. One key aspect favoring NIO's current position is its favorable valuation multiple. Despite recent selling pressure on the stock, NIO's sales potential remains attractive, with a price-to-sales ratio of 0.98 times based on anticipated sales in 2024. This ratio suggests a favorable risk-reward relationship for investors, especially when compared to competitors like XPeng, which trades at a higher P/S ratio of 1.4 times. Furthermore, historical data indicates that NIO has previously traded at much higher sales multiples, reflecting the company's progress in improving its gross profit picture over time. However, market forces, such as waning demand for electric vehicles in China, pose potential challenges to NIO's investment thesis in the short term. Despite short-term uncertainties, the long-term outlook for the electric vehicle industry remains positive, providing opportunities for NIO's growth. While the recent adjustment in delivery forecasts for the first quarter of 2024 was not ideal, it is not considered a significant setback. Anticipation of a gradual recovery in delivery volumes in subsequent quarters, coupled with NIO's low sales multiple, suggests a favorable investment opportunity with a strong buy recommendation. So now, considering the insights provided, investors should tailor their decisions based on their risk tolerance and investment objectives. For investors seeking higher potential returns and willing to accept higher risks, NIO could present an attractive opportunity. Despite short-term fluctuations, the company's improving gross profit situation and favorable valuation multiples may offer substantial upside potential over the long term. So, are you willing to accept short-term volatility for the potential long-term gains in NIO stock? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know about investing in NIO, just click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.